The recent decision by U.S. President Donald Trump to impose a staggering 50% tariff on imports from India has raised significant concerns regarding the future of approximately $30 billion to $35 billion of India's merchandise exports to the United States. This alarming development was highlighted by Tanvi Gupta Jain, the chief India economist at UBS. In 2024, India's merchandise exports to the U.S. reached a remarkable $87.3 billion, resulting in a substantial trade surplus of $45.8 billion. However, with these new tariffs in place, India could potentially see a reduction of nearly 1 full percentage point in its GDP growth over the next 2 years, according to Jain's analysis. In a recent conversation with the Indian Express, Jain also discussed the implications of India's potential reduction in Russian oil imports and the broader economic landscape, including growth and inflation forecasts, in light of the Reserve Bank of India's (RBI) latest monetary policy decisions. Here are some key insights from that discussion. The newly implemented 50% tariff on India, which includes a 3-week waiting period, raises critical questions about the future of trade relations between the two nations. President Trump has introduced an additional 25% tariff specifically targeting India's oil purchases from Russia, effective from August 27th, which adds to the existing tariffs. Certain sectors, such as pharmaceuticals and smartphones, are currently under Section 232 investigations and are exempt from these tariffs, accounting for about $24 billion, or roughly 30% of India's total goods exports to the U.S. To assess the impact of these tariffs, we consider that the U.S. represents 20% of India's goods exports, translating to about 2.2% of India's GDP. By applying the new tariff rates to this trade exposure, we can estimate the potential GDP at risk. Assuming a price elasticity of -1, we project that the proposed tariffs could result in a drag of approximately 35 basis points, BPS, in 2025-26 and 60 BPS in 2026-27. However, it is essential to note that these estimates carry a significant degree of uncertainty, particularly as trade negotiations with the U.S. are ongoing. Other factors influencing our growth forecast include the trajectory of global economic growth and whether counter-cyclical policy measures can bolster domestic demand amid tariff-related uncertainties. Currently, we estimate that the exports at risk due to these tariffs amount to around $56 billion. Specifically, out of India's $87 billion in goods exports to the U.S., after accounting for exemptions, the at-risk exports are approximately $30 billion to $35 billion. The 3-week pause before the tariffs take effect provides a window for negotiations to continue. Looking ahead, do we see any signs of a potential deal with the U.S. that could lead to a significant reduction in tariff rates without India compromising on its 2 non-negotiable sectors, agriculture and dairy? Drawing lessons from other Asian countries that have successfully negotiated trade agreements with the U.S., such as Vietnam, Indonesia, the Philippines, and Japan, we anticipate that India may need to open its markets to American goods, potentially eliminating tariffs on those imports. In exchange, India might commit to increasing its purchases of energy and defense equipment from the U.S. to address its substantial goods trade surplus of $46 billion as of 2024. However, the challenge remains in opening up the agriculture and dairy sectors, as this could jeopardize the livelihoods of many Indian farmers, particularly small-scale dairy producers. The dairy sector alone contributes 3% to India's nominal gross value added and supports over 80 million dairy farmers. In our base case scenario, we expect a trade deal to materialize sooner rather than later, as prolonged uncertainty could hinder overall economic growth. According to media reports, a U.S. trade delegation is expected to visit India in the last week of August to discuss these matters, which raises hopes for a productive outcome. Interestingly, the start date for the additional tariffs, August 27, coincides with the timing of the upcoming talks between the US and India. India's trade relationship with Russia is also a point of contention for the US. Can India find alternative sources for oil without significantly affecting domestic fuel prices, overall inflation, and government finances? As a net oil importer, India relies on imports for nearly 88% of its oil needs. Therefore, fluctuations in oil prices can have a profound impact on macroeconomic stability, including the current account balance, inflation rates, and government finances, ultimately influencing economic growth prospects. Before the onset of the Russia-Ukraine conflict in 2022, Russia accounted for only 2% of India's oil imports. However, this figure surged to 36% by 2024-25. UBS's oil analysts note that Indian refineries are typically designed to process heavier Russian Ural crude. Initially, the price advantage of Ural crude over Brent was highly favorable for India. But this advantage has since diminished to just $2 to $3 per barrel on a landed cost basis. Consequently, if India shifts away from Russian oil, the financial impact may not be substantial, as the current savings amount to only $2 billion. Moreover, UBS's global energy team has indicated that the crude market is only partially accounting for supply disruptions due to tariff pressures on India, which could temporarily push crude prices above $70 per barrel. However, if there is sufficient surplus and spare capacity from OPEC, this could help limit price increases. As the urgency to finalize trade deals intensifies, should there be concerns about India potentially conceding too much during negotiations or failing to secure favorable terms, it is important to recognize that India was the first. In terms of monetary policy, the RBI's Monetary Policy Committee has opted to maintain the current repo rate, but there are expectations for an additional 25 basis point rate cut in October due to the uncertainties stemming from the tariffs. How can we reconcile this anticipated easing with the central bank's latest forecast, which projects headline retail inflation at 4.9% for the April-June 2026 period? Our inflation forecast for 2025-26 was already tracking close to 3%, even before the RBI revised its estimate downwards by 60 bps to 3.1%. This positive outlook is supported by strong agricultural output, favorable monsoon conditions, and lower global crude oil prices. The offloading of excess capacity from China into India at lower prices could also contribute to a disinflationary effect. When we consider this alongside the RBI's neutral policy rate assumption of 1.4 to 1.9%, we see potential for the terminal repo rate to decrease to the range of 5 to 5.25%. For now, we are incorporating a 25 bps rate cut into our baseline for the October meeting, with the possibility of another cut if growth surprises on the downside due to US trade tariffs or a significant decline in global growth. While the one-year forward inflation rate of 4.9% appears elevated due to base effects, we anticipate that the new Consumer Price Index (CPI) series, expected to be launched early next year, will help clarify that one-year forward inflation forecast. At this juncture, we believe the RBI is maintaining some flexibility in terms of monetary easing to address potential growth risks that may skew towards the downside. Despite the global uncertainties, the RBI has kept its GDP growth forecast for 2025-26 at 6.5%, although it did reduce it by 20 bps from 6.7% in April. Is it possible that the RBI is underestimating the impact on growth, not just from the tariffs themselves, but also from the negative effects on corporate sentiment stemming from the uncertainty? I would argue that the RBI deserves some leeway. As the MPC meeting occurred before the announcement of the additional 25% tariff, if we only consider the initial 25% tariff that was in place prior to the RBI's policy announcement, our estimates suggest that the downside risk to real GDP growth for 2025-26 was only around 10 to 15 bps. Recently, we introduced our rural and urban economic activity indicators, indicating that household consumption recovery is expected to broaden over the next 2 to 3 quarters, supported by the RBI's rate cuts, lower inflation, favorable monsoon conditions, and income tax relief, among other factors. However, can this recovery be sustained without a significant increase in actual income levels? The UBS India Composite Economic Indicator, which incorporates 15 high-frequency data points, suggests that economic momentum weakened in May, aligning with our global growth nowcast that indicates tariffs and global uncertainties sharply curtailed growth in May after a resilient April, which had benefited from improved demand, production, and trade. Our activity indicators show that while rural economic activity has improved, urban activity has remained lackluster in the June quarter. Notably, rural consumption accounts for 46% of total consumption. Although rural activity is gaining momentum, we believe it is premature to expect a widespread recovery in household consumption, especially as urban activity continues to decline. One of the factors supporting our view that household consumption could be a bright spot in 2025-26 and 2026-27 is the expectation that urban demand will stabilize due to monetary transmission, lower inflation, and policy stimulus from income tax relief and potential fuel price reductions. We also anticipated a pay increase under the Pay Commission. However, the implementation of the 8th Central Pay Commission is likely to be delayed until early 2027. While household consumption will contribute positively to growth, we do not foresee a broad-based recovery in this area in the near future.